Hello, and welcome to the One Stock to Buy Right Now webinar. My name is Tim, your WebEx producer, and I will be in the background answering any WebEx technical questions. We have a few housekeeping items before we get started. If you experience technical difficulties during the WebEx session, please dial 1-866-779-3239, or you can message the WebEx producer using the Q&A panel. During the presentation, all participants will remain in listen-only mode, and as a reminder, this event is being recorded. We will be holding a Q&A session at the end of today's presentation. You may submit a question at any time throughout the event by entering it into the Q&A panel at the lower right of your screen. Please keep the drop down as all panelists. It's my pleasure to introduce Nathaniel Aikman, Senior Analyst. Nathaniel, the floor is yours.
Thanks. Hi, I'm Nate Ekman. I'm an analyst here at ValueLine. I'm joined today by two other senior analysts, Alan House and Charles Moran. Today, we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and, finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all of the equities under our coverage. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-ValueLine. Now, let's discuss the economy and the stock market. This content was prepared by ValueLine's economic staff. Progress on the inflation front has proven elusive thus far in 2024. True, the Consumer Price Index, or CPI, slowed a bit following a sharp spike in March. However, producer wholesale prices came in stronger than expected last month, and the overall pace of consumer price growth is still running above the central bank's comfort level. Treasury yields did retreat on the April inflation numbers, but not enough progress was made for the Federal Reserve to consider pivoting on the monetary policy front in the near term. The consumer sector is still dealing with high prices, even if increases have slowed a little bit. The CPI and the core CPI, which excludes food and energy, each rose 0.3% in April, a modest improvement from the March core increase of 0.4%. On a 12-month basis, the CPI and core CPI advanced 3.4% and 3.6% respectively. The CPI price data, though a bit cooler than the prior month tallies, indicate that the Federal Reserve is still having a hard time clearing that last hurdle of bringing price growth closer to its target rate of 2%. The level of retail prices has seemed to cause some spending fatigue in the consumer sector. On point, April retail sales were unchanged, coming in below forecast. Meanwhile, the Producer Price Index, or PPI, moved in the wrong direction last month. The PPI and the core PPI each rose 0.5%. On a one-year basis, the PPI and the core PPI increased 2.2 and 2.4% respectively. Both 12-month figures were above forecasts, with the former representing the biggest increase since last August. Meantime, first quarter earnings season was a success for corporate America. Nearly 80% of the S&P 500 companies reported positive earnings surprises, with profit growth averaging north of 5%. It marked the biggest gain for them since the second quarter of 2022, and such was needed to justify the high price-to-earnings valuations entering earnings season. In conclusion, with continued uncertainty about if and when the Federal Reserve will reverse monetary policy course, volatility in the U.S. equity and bond markets can't be ruled out. In this environment, we still recommend a portfolio led by high-quality companies. It should be noted that institutional investors worried about a reacceleration in inflation have increased their positions in gold. Please refer to the inside back cover of Selection and Opinion in the Value Line Investment Survey for our statistically based asset allocation model's current reading. On that note, Value Line provides a great deal of information and analysis to our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website, which once again is www.valueline.com. I will now show you how to access these reports. Once signed in on the website, head to the dashboard, where I am already located. This is the main landing page for subscribers. Under the Quick Links section, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you who don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly advise that you use financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the Investment Education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, we'll go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available, requiring a higher level of subscription. If that interests you, please call 1-800-VALUE-LINE. As noted in our current economic analysis, the current environment is one of lingering uncertainty, but also potential. As such, we'll be looking for well-balanced companies with strong 18-month return potential. We'll start the screening process by looking at the safety rank in the ratings and ranks section. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which once again is available free of charge from within the investment education section of our website. Today, we're going to focus on stocks with a safety rank of 3 or better. By applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 2,133 candidates. Next, we're going to filter for timeliness, another of our tried and true measures. Timeliness is a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. Like safety, it's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will at least keep pace with the overall market over the short term, so we're looking at stocks ranked 3 or better. By applying that screen, we've trimmed the list to 921 candidates. We also want a stock with decent potential returns over the long term. This figure is derived from analyst projections of cash flows, earnings, and terminal valuation of the next 3 to 5 years. For today's selection, we would like to have an annual potential return of 15% or better. So applying that, and our list is now down to just 506 possibilities. Now, today we're going to be looking exclusively at large cap companies, which are defined as those with a market capitalization of $10 billion or more. Although we've already accounted for risk via the use of the safety rank, it's worth noting that large cap companies are, in general, a bit less risky than smaller companies, so in the current environment, confining our search to large cap stocks makes sense. Applying that filter, we see our list narrow to 250 selections. Finally, we're going to look at price appreciation potential over the intermediate term. Today, we'll be looking at stocks with appreciation potential of at least 30% to the midpoint of their 18-month target price ranges. For comparison, the median appreciation over that span for all stocks in the value line universe right now is 14%. By applying this criteria, we've cut the list down to 22 candidates. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Axon Enterprise, ticker symbol AXON. Before I click on Axon, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top. Now, let's take a look at our last full-page report. Axon develops and manufactures less lethal weapons and other equipment for law enforcement, corrections, and personal defense applications. The company's best-known product, the Taser Conducted Energy Weapon, is available in both law enforcement and consumer models. Other products include police body cams and evidence management software. Turning our attention to the statistical array, you can see that our analysts predicted strong growth in 2023 based on the company's full-year results, which were released shortly after this report went to press, and we now know that to be accurate, with Axon posting earnings of $4.13 for the year. Note that this result exceeded our already high expectations. And, as a consequence, while I can't discuss specifics, I will say that our analyst is now estimating even stronger bottom-line performance for this year and 2025. This continuing pattern of growth from Axon should, in turn, help it to meet our 18-month price appreciation target. All of this updated data will be included in our brand new Value Line report on the company, which will be released in next week's issue. Each stock we cover gets a new report issued quarterly. And as I mentioned previously, should any important developments occur in between, we'll also issue a supplementary report to keep you up to date. Returning to Axon, the stock meets or exceeds all of our screening criteria. Overall, the company offers strong growth prospects, particularly into next year, and appreciation potential to match. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand it off to Alan. Alan, take it away.
Thank you, Nate, and thank you all for joining us today. I see an interesting question about the 18-month total return, and Value Line has been known for its time-tested, timeliness rank, and we've also done 3 to 5 year projections, which now go out to 2027 to 2029. But I believe probably about 6 or 7 years ago, we instituted the 18-month target price range, which we think is a good fit for intermediate term investors. There are some investors that are looking just the next 6 months to a year. Then there's other that are looking for the longer term, but there is a niche of investors that are looking 18 months ahead. So we believe that that helps those investors make their stock pick. So just wanted to clarify that. Thank you.
All right. Thanks, Alan. So I'm seeing a question. With the current investment environment around artificial intelligence or AI, do you think that we are in an AI bubble? Now, that is a very tricky question to answer, and I don't want to, come on too strong with, reducing a very complicated economic issue down to, specifics. But I think that the thing that I would say to that is that there is, I think, maybe a bit more. I think there are maybe more companies trying to move into the AI space than it can necessarily support. And this comes down to certain, hard economic facts about profitability and more specifically data availability, because creating these AI models requires access to a lot of high quality training data. And improving the models requires that the availability of that data to scale at an exponential rate. And the fact is, as much data as we have on the internet, the amount of it that is of a quality that can train good AI is such that we will potentially run out within the next few years. And so because of that, I think there's sort of an expectation from some people on the investment side that this will continue to scale at the rate that it has over the last few years. And unless some substantial strides can be made in improving the efficiency of the models, that's not necessarily feasible. And so I think we may see some contraction there in the future. But at the same time, some companies will, go on to survive, because the comparison I draw would be, the late 90s dot-com boom. I don't know that we'll necessarily see something quite that violent, but similarly, you have this very transformative technology. People get very excited about it. They put a lot of money in, but maybe expect things from it too fast. And then they're disappointed when it doesn't materialize as quickly as they think it will. But that doesn't change the fact that there is real potential with the technology, and some of those companies that were, around then, like Amazon, are still massive winners today. And so that's really the key thing, is looking at what the technology can actually do and who's actually using it effectively.
Okay, thank you very much, Nate. I also see another question about how to create a saved screen, and Nate, he mentioned that in his commentary. And if you go on the parameters that we did, by market cap and so on, there's a create save screen up here at the top of the up top. So you can just name the screen whatever what you want to name the screen and hit save, and that'll create the save screen. And that could be modified, that's updated obviously for the pricing activity and things like that. So if you want to create a screen with like momentum stocks or value stocks or maybe technology stocks or what have you, you can create that by using the save screen. So I just wanted to point that out. Someone had a question about that. Thank you.
Mm-hmm. All right. I'm not seeing anything else I think we can address. Alan, do you see anything?
No, I don't. I just like to thank everyone for joining us, and we'll hand it back to Tim.
Okay, great.
Webinar attendees, this does conclude today's event. Thank you so much for attending. You may now disconnect your lines and have a great day.